Good morning, friends. You are most welcome in Umesh Rastogi YouTube channel. Today we analyze the Indian foreign exchange reserves 2025-26 and its impact on Indian economy. The Reserve Bank of India (RBI) through its press release dated June 8, 2026 has explained the sources of variation in India's foreign exchange reserves during financial year 2025-26. While the headlines figure indicates an increase in reserves, a deeper analysis reveals a more nuanced picture of India's external sector. India's foreign exchange reserves 2025-26. What the RBI data really tell us? India's foreign exchange reserves increased by 22.8 billion US dollars during the financial year 2025-26. At first glance, this appears to be excellent news for the Indian economy. But the Reserve Bank of India's latest data reveals a deeper and more complex story. Did India actually earn more foreign exchange? Or did the reserves increase due to change in global market prices? Let's decode the RBI data and understand its implications for India's economy, banks, businesses, and citizens. Foreign exchange reserves are India's financial shield against external economic shocks. They consist of foreign currencies, gold holdings, special drawing rights, and reserve assets maintained by Reserve Bank of India. These reserves help India pay for imports, stabilize the rupee, and maintain confidence among global investors. The RBI reports that India's foreign exchange reserves increased by $22.8 billion during 2025-26. This is slightly higher than the increase recorded in the previous year. However, the headline figures does not tell the complete story. When valuation effects are excluded, India's reserves actually declined by $23.6 billion on a balance of payments basis. So, how did reserves increase despite a decline in actual foreign exchange flows? The answer lies in valuation gains. During 2025-26, India recorded valuation gains of $46.4 billion. These gains occurred primarily because global gold prices increased significantly and the US dollar weakened against major international currencies. In simple terms, India did not receive additional foreign exchange equivalent to $46.4 billion. Instead, the assets already held by the RBI became more valuable. The current account deficit widened from $23.1 billion to $25.4 billion. This indicates that India's imports continue to exceed exports. A wider current account deficit can increase pressure on the rupee and make the economy more dependent on capital inflows. There were mixed signals from foreign investments. Foreign direct investment remained positive at $6.9 billion, indicating long-term confidence in India's growth story. However, foreign portfolio investors withdrew approximately $16.4 billion from Indian financial markets. Such outflows often increase market volatility and create pressure on the domestic currency. The banking sector witnessed encouraging developments. Banking capital improved significantly and NRI deposits contributed $14.4 billion. For banks such as SBI and other public sector banks, this translates into stronger foreign currency liquidity and better opportunities in trade finance and treasury operations. The data also shows an increase in short term credit and external commercial borrowings. While external commercial borrowings support investment and economic growth, they also increase future repayment obligations and expose borrowers to exchange rate risks. The RBI data presents a balanced picture. India's external position remains stable and resilient. Foreign exchange reserves are strong, gold holdings are generating gains, and foreign direct investment continues to support growth. However, the quality of reserve accumulation has weakened because the increase was driven primarily by valuation gains rather than fresh foreign exchange inflows. Going forward, sustained export growth, stronger foreign investment, and prudent external debt management will be critical for maintaining India's economic strength. The key takeaway is simple. India's forex reserves are strong today, but long term resilience will depend on the country's ability to generate real and sustainable foreign exchange earnings. The RBI data presents a mixed picture of India's external sector in financial year 2025-26. While foreign exchange reserves increased by $22.8 billion, this improvement was driven largely by valuation gain of $46.4 billion, arising from higher gold prices and currency movements rather than strong foreign exchange inflows. The widening current account deficit, portfolio investment outflow, and decline in reserves on a BOP basis suggest that India's external sector still faces challenges. However, strong reserve level, positive FDI inflows, robust NRI deposits, and RBI's growing gold holdings provide important buffers against global uncertainties. India's external position remains stable and resilient, but the quality of reserve accumulation has weakened, making export growth, sustainable capital inflows, and external debt management critical priorities for the coming years. Thank you, friends, for patience listening. Please subscribe our channel and like and share the video. Thank you. Thank you very much. Namaskar.